How's it going, everyone? Today we have my friend DayTradingRauf with us, and he is going to be going over market maker models. Let's get started.
Okay, so before we begin, I obviously want to say a huge thank you to T for bringing me onto his YouTube channel. And with that, I do want to say a huge shout out to the MMXM trader and obviously ICT himself. ICT had a lot of influence on me in my trading, and obviously with his market maker models. And with that, I became friends with the MMXM trader. He's probably one of the best traders that I do know. And he has taught me a lot about these models, and I am going to share some light on them right now in this video. So this is the basic overview that I will be going over. So what are the MMXM models and what is the meaning behind them? Because a lot of people don't know what the definition is of the model. So if you don't know what the definition of something is, how can you trade it, or how can you fully understand what you are trading? And then we're going to go over old accumulation and new distribution, how this is paired together. And then we're going to go over mitigation blocks, then grading price swings. And when I go over grading price swings, we are going to go over when is the next leg high probability. What I mean by the leg, this is either the low risk buy or sell, the first distribution on the silver bullet. And if we have another area of accumulation, I will go over what makes that high probability. Okay, so let's begin. The MMXM models by definition are a mitigation of orders. What I mean by this, they are a hedging program. So without going too much into fundamental analysis such as using COT data and stuff like that, I am just going to go over pure price action, essentially how market makers are inside of the market and what they are doing. As the market makers models are a hedging program, this is all what market makers are also doing. They are facilitating trades for large institutions and anyone with large positions inside of the market. So there is two sides to market making. There's not always a positive side where the market maker is always making money. There is another side where market makers go into drawdown. This is where they are facilitating trades for large funds and institutions. So if we have a consolidation right here, price breaks out, and then we have another area of accumulation. So this was our original consolidation, and price broke out and we started accumulating here. As we have buy side liquidity above these highs and sell side liquidity below these lows, the market makers will sell short here, facilitating buy orders. So anyone that wants to go long here, they can be long, and the market makers will facilitate their trades. And over here again, this is another area of accumulation. This is where trades are being facilitated, so anyone that wants to go long, they can go long because the market makers are selling short. So throughout this whole fractal right here, this is where they are in drawdown. So then we have a smart money reversal. This is where they will accumulate more short orders, and any traders that are trying to buy on a breakout right here, they will be facilitating their short orders. This is where you will find your bearish breakers, which will trade into here. This will be a great PD rate to trade off of. So when I am talking about this diagram, I obviously mean this on a high time frame, such as a daily and weekly time frame. I don't mean the 1 minute chart or the 5 minute chart. Obviously these models are fractal and they do occur on the 1 minute and the 5 minute chart. However, large institutions and banks, they are trading on the daily and the weekly time frame because they simply can't position themselves on the lower time frames like the 1 minute, 5 minute and the 1 hour. So as they have been in drawdown throughout the whole buy side of the curve, this is where they will be selling more and more until we get to the original consolidation, which gets cleared. And this is the whole process of a market maker model and what they are by definition and what actually is happening inside of market making itself, because they're not always trading for profit. They are there to facilitate orders for large participants in the market. So I hope that made sense. I didn't want to go into too much detail and confuse a lot of people, but that is just the foundation of these models and what they are by definition, how they intertwine with what is actually happening in the market itself. I do have a full video on my YouTube channel that you can check out about these market maker models that go into much more detail. But for this video, I'm just going to cover all these topics right here. So now you guys know what market maker models are and what they are by definition and how they intertwine with the market. We're going to move on to old accumulation and new distribution. So when you are looking at old accumulation, you want to look at old fair value gaps only. So if you find a fair value gap like this, and you can see that this has been accumulated for the next 60 days, if you draw these lines out in time, you will find for the next 60 days that the algorithm does come into these levels again, and they are used as new accumulation areas. So this is where the new distribution occurs. However, I'm going to go over this in a market maker model. So as you guys can see, this fair value gap right here from this low to this high, this is where we accumulated shorts and we had a run lower. So if we draw this out in time, you can see that this becomes an inversion level. However, this is just not an inversion level itself. This is where we had an area of old accumulation, which now turns into new distribution of longs. So if you split up the buy side and the sell side of the curve, this is the buy side of the curve, this is the sell side of the curve. So any fair value gaps made here, this is what you will be drawing out in time, and you will see that price respects these areas on the buy side of the curve. So I'm drawing all these out. You can see that price will respect all these levels. So this is what you want to be looking for. When you are bullish, you want to be seeing the sell side of the curve, bearish fair value gaps being respected and being accumulated. So you can see all of these fair value gaps we trade into and we have an area of selling. You see here we go into the fair value gap and we sell away. So this was an accumulation of shorts, and then we have a reversal and we trade higher, and you can see because this was accumulated heavily and we traded away, this was a perfect area for reaccumulation, and then we trade away. So this is how you can view old accumulation as new distribution. You don't want to map out any old fair value gap that was made here. You want to be looking at the fair value gaps that have already been accumulated and price trades away from them. So this is also known as an old gap, and as I spoke about before, if you draw out these old gaps in time, you will find that price often does refer back to them. So this is how you can use old distribution and new distribution. So if you have made it this far into the video, I do get a lot of questions about how to know when a market maker model is likely to reverse. So those that have made it this far, I'm going to tell you that now. So this is where a reversal usually occurs on a market maker model. When you split this in half, this is where we have the buy side of the curve and this is the sell side. And right in the middle is the reversal, known as a smart money reversal. So this is where you want to see a change in the state of delivery. I know this is a very vague term, so I'm going to go into a bit of detail right now. Instead of looking for an order block which forms here, so you will be looking at this candle and price respected then trade away, I want you guys to focus on a breaker. The silver bullet only forms when we trade through a breaker. So I want you guys to listen to that again, and if you want to write it down you can, but the silver bullet only forms when we trade through a breaker. So from this low to this high to this lower low, this is our bullish breaker. So if these up close candles, they will be drawn out in time. And you can see this is where we trade into the breaker and we trade away. So how do you know you should trust a market maker buy model now? This is because we traded through this breaker. So these up close candles, once we have a body close above them, like here and here and here, this is where we have an area of fair value. So when we have an area of fair value and a bullish breaker, this is obviously known as one of the strongest algorithmic entry and patterns there is. So this is where you can know that price is likely to reverse once we trade into an area of fair value and a breaker. So this is the first step that you look for: price to trade away above and close above the breaker, a fair value gap to be made or an area of fair value. So you can see here, this is fair value from this low to this high. Price comes into 50% and then we come into the breaker and we trade away. So this is how you can know that price is likely to reverse, and this is what you can refer back to. So now we've covered old accumulation and new distribution, and I've given you some tips about reversals and how you can know that price is likely to reverse. Now let's go over mitigation blocks. I'm trying to make this video not too long, but I am trying to condense a lot of information into a short video. There is a lot more to these models, but I'm just showing you guys the basics and covering the fundamentals of these models. Next we have mitigation blocks. So next we have mitigation blocks. This is the sell side of the curve and this is the buy side of the curve. So the mitigation block, just like old accumulated fair value gaps, work perfectly for an entry. So when you have three PD arrays overlapping each other, this is when you know the entry that you're about to take is very high probability, because three PD arrays are supporting your trade idea. Vice versa, so if three PD arrays fail, this is how you know that your trade idea is not valid. So all of these up close candles right here, they are mitigation blocks. Not every single one of them, and I'm going to go over how you can characterize which ones. So this candle right here, this is a mitigation block because this is what came into fair value. So this is the fair value gap. This candle came in. So this will be used as our mitigation block. We will draw this out in time, and this is what we will be using to see if price will respect it, and this is how we will know that the market is still bullish. Let's draw this candle out in time. You can see price comes back into it and we trade away. So how do you know that a fair value gap is going to be a breakaway gap? This is where we utilize mitigation blocks. So this mitigation block right here, price trades into it and we trade away. We trade into this fair value gap as well. So we have about two PD arrays overlapping each other. This fair value gap now becomes a breakaway gap because we have already accumulated longs inside of the mitigation block and this fair value gap. So you can expect this fair value gap to stay open. And if you wanted to go long, you can still go long here. Your stop loss can be below this low. And you can target the original consolidation. However, this is how you can anticipate breakaway gap when we have a mitigation block and a fair value gap overlapping. And if we have 3 consecutive fair value gaps, use the one in the middle and expect the one below it to stay open. I will go into a bit more detail about breakaway gaps in the grade and price swing section of this video. This was our mitigation block. This is another mitigation block that price trades into and we accumulate inside of it. So as we have 2 of these candles right here, you want to merge them into one. So pretend this whole green up move is just one candle and draw it out in time. You can see how the bodies are closing inside of this whole up move. So these were 2 mitigation blocks. You can see that we accumulated inside of this fair value gap and these 2 up close candles. Draw them out in time. You can see this candle trades lower into the gap and we trade away. So this is our bullish breaker right here as well. This was a low, this was a high, and this was a lower low. This candle right here, draw it out in time. You can see we have 2 PD arrays overlapping each other again. We have a bullish breaker and we have a mitigation block. Price trades lower. This is where you can buy, stop loss below here, and price moves higher. Towards the end of the video, I am going to go onto my Twitter page and we can break down some of my trades that I have took. If you go on my page, you can see that every single trade I take is based off a market maker model. And if you reverse engineer my trade, you will begin to see that 85% of the things I'm doing is what I am teaching right now and what ICT has taught me. So then again, if I draw your attention here, this candle is our mitigation block. This up close candle has a lot more volume compared to this small green candle here. So this is what we will be using for the mitigation block. And you can see that there is a fair value gap overlapping. So this is where we accumulated shorts and we traded lower. So if we highlight this, draw it out in time, you can see that we accumulated more longs. And price traded away into the original consolidation, which gets cleared out. So this was a bit about mitigation blocks and how you can utilize them in price action. Next, we're going to go over grading price swings and how you can anticipate breakaway gaps. So this is how you can grade the price swings inside of a market maker model. If you guys want to copy my Fibonacci settings, they're right here. So this is what you want to do from the area which created the smart money reversal to the original consolidation. This is where you want to draw out your swing. This whole projection will give you clarity when you are trading. So if you look at the 25%, this is where our bullish breaker formed. You can see we took sell side and this is the breaker. So this is what price trades into and we trade away. So as we traded at the 0.25% of the dealing range, this is where you expect the low risk buy or the low risk sell to form. So anything below 0.25, this is where the low risk sell or the buy will form. Look here, this tiny fair value gap which was made, this was the low risk buy. This candle trades into the gap and we trade away. So this was the low risk buy and this formed below the 0.25 of the dealing range. Now you want to draw out your bullish breaker. You can see just above the 0.25 of the dealing range, this is the first distribution. So this is what occurs after the low risk buy. And you can see price trades into the breaker, we trade away. Now we have the silver bullet. So I want you guys to write this down. If the silver bullet forms below 50% of the dealing range, this is high probability. You can see we have the mitigation block right here. Draw this out in time. Draw this mitigation block out in time. This is the silver bullet. When we return back into fair value here, this is below 50% of the dealing range. This is where the highest probability entry will form, and this is where price will move the fastest to the drawn liquidity. As you see here, we move away. So I want you guys to write this down as well. So if the silver bullet forms below 50% of the dealing range, anticipate the next area of reaccumulation to be fast and quick and move away and clear the original consolidation. This is why I put importance on mitigation blocks, where you can long and you can expect price to trade away quickly. Why? Because the silver bullet formed below 50% of the dealing range. So you can expect the next area of accumulation to be high probability. So don't refer to the fair value gaps, refer to the mitigation block, because the silver bullet formed below 50% of the range. And any area of reaccumulation at 0.75 of the range, we should never come back to 50%. If we come back to 50%, get rid of the trade idea because it is invalid. As you can see, we're at the 0.75 of the range. Price trades into the mitigation block and we have a fast rally away. So this is a perfect example of a market maker model. Obviously, like everything in trading, it's not going to be 100%, but this is what you should be referring back to. And I have given a lot of source about these models in here that you won't find anywhere else. So we went over grade and price swings, and I went over when is the next leg high probability. So the next leg is always high probability when we have the silver bullet forming below 50% of the range. So anything over at the 0.75, this will be your highest probability entry because the silver bullet is already formed. The next leg that we have an accumulation area, this is where you can buy long or sell short, because you can expect price to not trade back to 50% of the range. If price does trade back into the 50% of the range, this is where your trade idea will become invalid. I know this was a lot of information to take in about these models, but I have tried to condense it into an easy way that I can and the smallest amount of time. But if you guys do want to check out my YouTube channel or my Twitter page, I'm sure T will leave a link to that down below where you can check out all my trade breakdowns and all my videos regarding these models and where I go into much more detail. But other than that, I hope you guys found this video insightful and you guys have learned something new, because I think that is the most important thing. As long as you learn something new that can benefit your trading or help you to profitability, I think I've done my job. But anyway, I want to give a huge thanks to T for bringing me on and you guys for tuning into the video.
Yeah, thank you for hopping on and giving us some insight into market maker models. If you guys do want to learn more, make sure to check out Ralph's YouTube and Twitter. I'll link those in the description below. And other than that, I hope you guys have a great rest of your day.